Hi, everybody. My name is Paul Sundin. I am the CEO of Empyrean, and I am joined today by Zach Gwynn. He heads up the sales side of our business.
Hey, Paul, thanks for inviting me and happy to join today.
Today, we're going to discuss the top 10 questions that prospects have. You probably are aware by now, but cash balance plans and other defined benefit plan structures are rather complex. So there's a whole series of questions people have when they're looking to start up a plan. We're going to go about a half hour today on this call. And then our goal is to do a full video on each one of these questions. But at least this will be a good starting point for you. And you'll have some basic questions answered that'll give you a little bit more insight into whether or not a plan is going to be a good fit for you. So take it away, Zach.
Thanks, Paul. Just as Paul kind of said, because we often get reoccurring questions from a lot of our prospects, we thought it'd be helpful to just give a top 10, just kind of overview of the most common questions we receive. So with that said, one of the first questions that we receive, Paul, is, because defined benefit plans aren't really cookie cutter and slightly more complex than your typical 401ks or IRAs, do plans really make sense in a business owner situation is the number one question often we receive. So what are some of the most common situations that you see where a plan really makes sense for a business owner?
All right. Well, cool. Starting it off here. The good fit for a client is, first of all, someone who's got high income. How do we define high income? Our average client's probably 5 to 700,000. But certainly, even if you make a couple $100,000 a year plus, it can make sense as long as you're a little bit older and you certainly don't need the money to live off of. So high income, typically high tax bracket, someone who's in a high taxing state, obviously because these plans are tax deferred. They're going to make more sense to someone in California than someone in Florida. They also make sense for people who are a little bit older. I would say the sweet spot is kind of mid 40s and older. You can get larger contributions into the plans. So they can work very well for younger people, but typically people a little bit older, people with fewer employees also is great. I'm not saying a plan doesn't work if you have, over 10 employees, but most of our clients have 10 or fewer employees because the economics get a little bit tougher the more folks you've got in the plan. And also another thing is someone who's got some consistent income. If you make a lot of money in 1 year, maybe not so much in a couple years, and then you make money again, you really want kind of some consistent income. We'll talk a little bit more about plan permanency, but you want someone who's got consistently high income so they can fund for a period of years at least,
Yeah,
Hopefully
absolutely.
I got them all. I don't know if you see any other ones, Zach, or anything I missed there.
No, that was a great overview. Absolutely. And then additionally, as far as the amount that a business owner could contribute to these plans, I get a lot of questions, relating to online contribution calculators and being able to, contribute upwards of 250,000. Obviously, these plans aren't really that simple as a plug and play calculation. So, how much can a business owner realistically contribute each year?
Yeah, great question. These plans, like you said, there's a lot of moving parts to the plans, a lot of variables, and we have our own calculator that we use. People like it as a starting point, but it's just that it's a starting point. There's a lot of ways that you can set up these plans to make them, to get more money in up front, to get, to designate a certain amount of contributions over time. So a lot of flexibility in the design. But as a general rule, most people will combine them with 401k plans, which we're going to discuss here in a little bit. Someone in their 30s, can usually get in, 150,000 between plans, give or take. 40s, you can be in the 150, 200 range. 50s, easily can get 250 plus. The best sweet spot for these plans is someone around the age 61, 62. You could be in the $300,000 to $400,000 range for these. So just kind of gives you a general idea. The plans are driven largely by age and W-2 compensation. And so we want, generally speaking, people who are older and people who have higher W-2s. That's where the high income comes into play. So that's really going to drive your contributions. Sometimes people say, hey, I saw online that I can get 250 into a plan. I'm 40 years old. My W-2 is $30,000. while there's some certain tips and tricks we can do to sometimes hit numbers with lower W-2s, the moral of the story is to get those higher contributions, you're going to need to have higher income for a sole proprietor or higher W-2s. A lot of variables, but again, I think use those calculators, those online calculators, as a starting point to give you a rough idea of what you can do. And then at that point, you can reach out to us. We can run an illustration and we can give you a better idea of what your funding will look like and try and customize a plan that's going to fit your specific needs.
Makes perfect sense. Yeah, absolutely. Now, you had just mentioned a strategy in which a business owner can kind of front load a plan. So I'll get that question a lot, can I contribute as much as possible for the first year and front load that plan? In what instances does that make sense? And are there any drawbacks to consider?
Yes. So, kind of thinking about those calculators are just giving you a general sort of base contribution or maybe a maximum amount that you can get in based on your age. But, when it comes to your first year of having these plans open, you have a lot of flexibility. In fact, I jokingly say to clients sometimes, they say, how much can I get in? And I say, what do you want the number to be? Which is a little bit of an exaggeration, of course. But you've got a lot of flexibility in year one because you can look at prior service. You can look at how many years they've been with the company. You can take a look at the income they've had in the past to be able to get larger contributions in. So hypothetically, we could find someone, even though the plans are driven by age and W-2, you could find someone who's a little bit younger who we're going to get a lot in up front. Now, the one thing you need to realize is that these are not defined contribution plans. So every amount that you put in a given year affects the future years, okay? Every dollar you fund today is one less dollar that you can get in the future, okay? So what you need to consider is, yeah, that's great. Maybe you want to do 250 this year and we can get a whole ton in because we're going to pull in prior service, but that's just going to reduce your future contributions, all things being equal. It's going to make your contributions lower. But a scenario where that really works well is if you had higher income this year. So if you made $1 million this year and maybe next year you think you're only going to make $200,000, that's a great opportunity for you to front load the plan, get a huge contribution in this year. Let's assume you're in the top tax bracket, maybe 40, 50% bracket, get a huge contribution this year. And then yes, it's going to pull down your contributions in future years. But if you're going to make $200,000, you're going to be in a much lower bracket. And economically, that can make sense. So, as long as you understand the mechanics of it, I also call it robbing from Peter to pay Paul. People just think I can put this maximum amount in and I can just do that every year. If you've got a fixed defined benefit that you're working towards, again, every dollar today is one less dollar in the future. So again, definitely front loading and prior service we do a fair amount of that. It just comes with that caveat to make sure you understand that you're probably going to get some lower contributions going forward.
Yeah, that's actually a great leeway into our next question because I get a lot of questions regarding the minimum requirement every year. So as we know, these plans are employer-sponsored retirement plans, and they're going to cover all eligible employees of the company. So every year there's going to be a funding minimum. What's that funding minimum, and what instances have you seen where a client is unable to even fund the minimum?
Yeah. You are correct as a general rule that these plans are going to have minimum amounts. Again, we're looking at a plan that in theory is going to be in existence for many years. And we're going to have this defined benefit amount at retirement. So as a general rule, the actuaries are going to require at least minimum funding every year. Some people have gotten confused where they've said, hey, you told me I was always going to have a minimum. Well, that's as a general rule. But when we talked about front loading, you're putting in a lot in year one. So it's conceivable that in year two, you don't have a minimum because you put in so much. But as a general rule, you always want to assume you're going to have a minimum contribution. Well, how much is that? Look, it depends. Again, it depends on age, W-2s, things like that. Obviously, if you're younger and your W-2 is a little bit lower, even if it's a reasonable wage and it's a little bit lower, that's going to justify a minimum. So there are some things you can do to drive that minimum down. You wouldn't want to be an older person with a very high W-2 and then saying, I don't want to fund this year, or I want to fund a very small amount. Hopefully at that point, your plan is very overfunded So you wouldn't have much of a minimum contribution to do. But it just always depends. I do tell clients as a rule of thumb, there's a lot of ways that we can control minimums. But if you come to me and you say, on the setup, you say, hey, Paul, I want to get 200,000 in this year, but man, it's going to be tough for me next year. I don't know if I can fund anything. Well, this might not be a good plan for you, because if you say I can't fund anything next year, again, that's, there might be ways to accomplish that, but it might be a little bit more challenging. You might not be a great fit. But, maybe you can do $20,000, $30,000, $50,000, a rather nominal amount with these plans. And of course, any 401k contributions are elective, so you don't have to do those. Then that situation can generally work. Now, if you can't make the minimum contribution, as a general rule, you got to pay about a 10% minimum penalty, excise tax penalty on the minimum. So it's not ridiculously high. But again, if you're sort of living paycheck to paycheck, these plans aren't going to be great for you, because you got to assume you're going to have some minimum contribution amount,
Right, that makes sense. Well, I've also seen it in instances where we had clients where he was just putting twin daughters through Ivy League schools. So suddenly he had high tuition bills on top of a mortgage and a couple of other expenses. So suddenly, his minimum started to become unattainable and he couldn't fund that. In those instances, do you have any kind of guidance for how to amend the plan or how to go about, correcting that?
Yeah, if we're going to amend to reduce a plan, we want to catch that before someone actually earns, the 1,000-hour requirements on something like that. But there's a handful of things that can be done. Remember, these plans can be funded up to the date the tax return's filed. So sometimes they don't have the money today, but they're going to have it in 6 months. So that can help. You also can borrow from the plan, typically up to $50,000. So I've seen situations where people borrow for the plan, contribute the money back to the company, and then fund the plan. There's a couple tips and tricks that you can do, but often, freezing a plan or, getting a compensation level that's low enough, as long as we catch it in enough time, usually that can help out a lot in those situations.
Perfect. Yeah, that makes a lot of sense. Okay. And then let's just change up the topic a little bit and talk about when the plan involves different employees. So a lot of times I'll talk to business owners and they have a couple of different employees and they might be even under the impression that they can keep out the employees and just create a plan for themselves. Can you give a little bit more detail, what's involved when there are employees involved with the company?
Yeah, absolutely. Like I said, initially it's great if you don't have any employees for plan purposes, because it's a solo plan, or maybe you have a spouse, a lot less complexity in a situation like that. But when you've got employees, again, typically over 10 employees, not going to make a lot of sense. 10 and below can make sense as long as you're in a high income, high tax bracket, older person with, and also someone with, younger employees. It can often make a lot of sense. But it just really depends on the situations with the employees. It might not be the best fit. With these plans, we really want that disparity between age and income for employees. So we want an older owner with a high W-2, and we want a younger employees with, let's say, employees in their 20s, 30s that are maybe making $20,000, $30,000 a year. The disparity is really what we want. Okay. Also, there's things that we could do with entry dates. We can exclude people in the first year or two. There's also vesting. There's a lot of things economically that we can have make sense. As a general rule, Zach, we talk about this. Usually if you can allocate up to 80, 85% to the owner, typically it can make economic sense, and there's ways to limit it. But I would agree with you that owners sometimes come to us and they say, hey, I want to set up a plan. We say, how many employees? Oh, I got 10 employees. Oh, but it's not for my employees. It's just for myself. We have to tell them there's, discrimination testing involved. You have to give your employees something. I say, you can take a large contribution, but you have to kind of give, peanuts or pennies or at least something to your employees to pass testing. So again, not perfect. There's not a one size fits all when people have employees, but again, we can run a free illustration for you, give you an idea whether or not the economics are going to make sense. That way you can review it with your CPA, think about vesting, the tax deductions you're going to get. Also, we're getting a lot of credits thanks to the Secure Act 2.0. Clients can get a lot of credits when they have employees and things like that,
Yeah, absolutely. And I've seen it in instances where even young business owners, these plans still make sense even if there are employees involved, and they can still contribute a good amount. So a lot of times it really just boils down to a numbers game in a lot of those, instances.
And I find that most owners don't mind giving some to their employees. They don't mind giving
Mhm.
them a percentage. I don't know what that amount is, 5, 10%,
Mhm.
but they don't want to give $20,000 to each employee or something like that. So a lot of times we can make the numbers work, but again, every situation is a little unique.
Absolutely. Yeah. Speaking of which, I've seen a lot of business owners who already have a retirement plan already set up for their company. So we'll get the question, can they still have the retirement plan? Can they still set up a DB plan if they already have a retirement plan set up, like a 401k? Could you just give a little bit more details about what a business owner should be aware of regarding combining a DB plan with another retirement plan they already have set up?
Yeah, absolutely. Realize that, some people think that they can just, there's a half a dozen different types of retirement plans. Some people think that they can just layer a retirement plan on top of retirement plan on top of retirement plan. And specifically, the IRS excludes a lot of plans from being combined. So a lot of plans out there just cannot be combined at all, but many can be combined, but they have restrictions. Now, most people come to us and they've already got a plan in place. They've got a starter plan. Maybe they've got a SEP or a 401k. In fact, probably 95% of our plans are combined with a 401k. And I don't mean into one plan, but I mean two separate plans that work together and are tested. You can always do the deferrals, the employee's deferrals. There's no limits there as long as you've got the income. But the key thing is, like when you're an S Corp, your profit sharing is capped at 25% when you've got a W-2, but for your profit sharing on your 401k. But when you combine it with a cash balance plan, you'll find that your profit sharing is limited to 6%. So in most situations, you're going to lose, $10, $20, $30,000 in profit sharing contributions, but you're going to pick up a very large contribution on the cash balance plan side. So of course, the economics will make a lot of sense in that scenario. So again, used all the times with 401k plans, just keep the 6% rule, in mind. When it comes to SEPs are a little unique. SEPs, there's two types of SEPs. There's a model SEP and a non-model SEP. Model SEPs cannot be combined with any sort of defined benefit plan structure. So you cannot fund both plans. You can have it open, you can have prior funding, you just can't fund it in the same given year. Now, non-model SEPs are more custom plan designs. You can combine them, but you're still limited to the 6% rule. So we rarely see people with non-model SEPs. There's only a handful of situations where I do recommend it. That's especially someone who's a high income earner who's already got a 401k through a day job, because a SEP does not require a 5,500, so the compliance can be down a little bit more. So some reasons why it can make sense, but as a general rule, no. So again, these plans do not combine well with SEPs. I know we talk to clients all the time about that. They combine great with 401ks. Again, probably 95% of our plans combine them as such. Just you got to remember that 6% rule,
Absolutely. Okay. And on a different topic, I was just talking to a client who has a 3-year contract set up with a hospital. And he's a little bit worried about maybe that contract not renewing in the future and whether or not it even makes sense for him to set up a plan right now for himself. So can you just talk a little bit more about plan permanency and, some of those concerns about maintaining a plan for a number of years?
Yes, great question. We get this one a lot. The IRS says these plans should be permanent in nature. That being said, you don't have to have the plan open forever, okay? You want to have it open at least several years. How long is several years? Nobody really knows. You'll hear people say 3 years, 5 years, 7 years. I tell clients, go into these plans with long-term intent. Assume you're going to have this plan forever, okay? But life is probably going to change. Something's going to happen, and you're not going to want the plan, or something in your situation is going to change 5, 10, 20 years down the road, and you might want to terminate it at that point, okay? So go into it with a long-term intent. I would say, generally speaking, you want to have a minimum 3 years. In your situation with the contract, look, it's probably a consultant that they're getting a contract. They don't know what's going to happen after 3 or 5 years. I mean, we saw a lot of unknowns with COVID and things like that, and people needing to terminate plans. So, go into it with this long-term intent. And, if you've got the contract and you expect to be a consultant for years to come, I think that sounds like long-term intent to me, and hopefully you'd have the plan forever. If something changes, someone comes along tomorrow and offers you a dream job, or you lose a big contract or something, absolutely for reasonable cause, you could terminate these plans. What the IRS doesn't want is, make $1 million this year, open up a plan, make a big contribution, not terminate it, set one up 3 years from now, make a big contribution, go back and forth. Obviously they don't want you to play games with these things, but typically as long as you have long-term intent, you're in good shape.
Yeah, absolutely. And I've seen it in instances where a client will even sell his business or, like you said, take their dream job or go working for another employer. And obviously at that point, with business and life just being uncertain, in those instances, it's perfectly okay to terminate a plan, correct?
Yeah. We did see a situation recently. I knew a guy that was saying, "Oh, I'm going to work forever." Someone came along and offered him a big chunk of money for his business. Obviously, depending on how the business is structured, or should I say how the acquisition is structured, the plan could carry on with the new owner. But in many situations, they're going to want to terminate it. So absolutely, life, there's a lot of unknowns to it. As long as you go into it with kind of this long-term intent, if something happens in life, usually you're in good shape. As long as you've got reasonable basis for doing that, which again, in most of these situations is fine or
Yeah.
should be fine,
Yeah. Outstanding. Okay. And then in regards to another concern that some prospects bring up frequently, they, are under the impression or they hear that there's penalties when a plan is overfunded. How does that work? And should a business owner be concerned about overfunding a plan or coming across any penalties?
Yeah, sometimes they see online. In fact, sometimes they stumble across some of our articles on overfunding where we talk about a 90% penalty and things like that. Absolutely. If you terminate an overfunded plan, you can pay a 50% excise tax, and then all that excess comes back to you as what they call reversion, which is subject to income. In fact, as a general rule, it's going to eat up 90% of your overfunded amount. If you're in California, it's going to eat up basically all of it. Okay. So can happen. We almost never see it happen. Okay. The general rule is you would never want to terminate the overfunded plan. And that's only upon termination. But people do get concerned. They get worried, wow, it's going to be overfunded or whatnot. And typically what happens is, people get a funding range that they can contribute. And if they start funding it very aggressively, the plan can be overfunded. And let's say at some point, 5-10 years down the road, they want to terminate it. Generally speaking, we run the numbers to see if they can or where the plan sits. They might need to leave the plan open a couple years to let some of the additional years of service roll out with the plan, so they're not going to have any penalties on it. So there's a few things that you can do to mitigate that. So for 99% of clients, should not be an issue. However, these plans should generally be conservatively invested. So if you want to get a 5% return, 0 to 10% is usually generally fine. But if you see, for example, you've invested in Nvidia stock or something and your assets are going through the roof, and maybe you're on the younger side, or maybe you've got, maybe you're in your late 50s, 60s, and you're approaching a few $1 million, you should be a little bit more concerned. We typically reach out to our clients in those situations, or we tell them to make sure they reach out to us as well. So, once you get older and you get to the max of 3.5 million, it can be a little bit more sensitive. But for the average client, usually not something for them to worry much about.
Yeah, absolutely. Makes perfect sense. Okay. And then in regards to the differences between these plans and like a 401k, sometimes I'll get a prospective client who's under the impression that they'll be contributing much like a 401k, where they'll be deferring part of their paycheck. That's not at all correct, right?
Yes, you're correct. These are company-sponsored plans. And so the company is making the contribution. And so as a result, the company is going to take the tax deduction on the return. And this is what I'm assuming an S-Corp return or C-Corp, a corporate return, a little different for sole proprietors and partnerships. But since the company is going to make the deduction, it's going to be on the tax return, just like, a CPA fees would be, office expenses, telephone, things like that. So it's just a deduction like anything else. People sometimes think, yes, it's specific to the employee, like a deferral. When you make a deferral, when you defer a portion of your paycheck into a 401k plan, you're going to pay Social Security and Medicare on that deferral. You're going to pay employment taxes, but you're not going to pay federal or state income taxes. That money is going to go into an account. You're going to pull it out at retirement at some point. It's going to grow tax deferred. These plans aren't going to work like that. They're going to be like, again, company sponsored, kind of like the 401k profit sharing. Sometimes people, have a 4% match at their company or something like that. The company is taking that deduction. They're just putting the money in your account, but it's not something that it's going to show up on your W-2. So don't assume that these plans are going to show up on your W-2, or something on the deferral side. Again, they're company sponsored. And that does come up from time to time, especially for people that currently have 401ks in place. And, let's face it, that's the most, people understand that structure and they're most used to 401k plans as general anyways,
No, exactly. Because most of our clients, they're aware of the 401k and they've participated in one, but these plans, certainly act in a very unique and different way.
Yep, absolutely.
Yeah.
Absolutely.
And lastly, Paul, when we started off, we talked about when a plan really makes sense for a business owner. But to kind of bring it full circle, and for the last question, what instances and situations do you most commonly see where a defined benefit plan just doesn't even make sense for a business owner?
Yeah, absolutely. I know we've covered some of these areas. Lower income, lower taxing environment, volatile income, large quantities of employees is typically a situation. People will come to us and they've got 10, 20, 30 employees. Again, can make some sense if someone's got, $500,000, $600,000, $700,000 a year of income or even more, can make some sense to get the tax deferral. But if someone's making a couple $100,000 with 10 employees, usually not going to make sense because they've got to have a W-2 and some earned income that's going to be high enough. Sometimes it's a little tougher for younger employees, although there's a lot of reasons why these plans can be beneficial for younger employees. I know we've covered that in other situations as well. But those are some very unique situations. Remember, more employees too mean more fees for people. And so the good news is our fees are tax deductible, but if you've got 20, 30, 40, employees, you could find fees from us being 10 grand or so. So the fees are going to be, a barometer for people. Sometimes also, Zach, to tell you the truth, most of our clients don't want to pay tax. I'm not saying they don't want to pay taxes. We all have to pay taxes. They want to defer as much as possible, right? And do it legally. If you're the type of person that says, hey, I'll just pay the tax now. This is too complex. There's all these rules. There's all this testing. I have a high income, but I'm really confused. This doesn't make sense. A situation like that where someone's having a tough time grasping the concepts, or simply does not want to grasp the concepts, not eager to invest the time to understand how the plans work, that's typically not going to make a lot of sense. And, we really don't try to do a hard sell on people. We want people who are a good fit with us. And so, if you're not a good fit, very likely we're going to tell you up front, you're not a good fit. You know what I mean? So, usually, we can pretty much, figure that out up front with the initial call,
No, absolutely. Because you bring up a couple of different scenarios that I've come across, and one in particular where I was talking to a business owner who owns several different restaurant chains. And he had over, I think, 60 employees between all of his, restaurants. And especially in the restaurant industry, there could be good years, but there could also be down years. So in that situation, with the volatility and the amount of employees he had, plan probably just doesn't make a lot of sense.
Yep, absolutely. Look, I agree with you. What you'll find is situations with restaurants, retailers, a lot of turnover. Now, granted, younger employees, lower paid, part-time employees often, but tracking the turnover, tracking the vesting, the cost, those plans are also subject to PBGC insurance because they're not professional services. All those combined, all the criteria makes them very challenged. In fact, I've been involved in plans for, several thousand plans over the years. And, I've almost never seen them. I can think of one restaurant situation, and it was a high income restaurant that was very small, had 5 or 10 employees, and they're mostly family owned business, where most of the employees were family. The owner didn't mind the contribution, but you're absolutely correct. Situations like that where you've got, landscaping companies, air conditioning repair services, auto shops, a lot of those types of situations just aren't going to make sense because the economics, the plan fees, all that stuff just not going to be worthwhile for the owner, you know?
Absolutely. Well said. Well said. Well, Paul, appreciate your time so much. I hope this was very helpful for a lot of our clients and prospective clients. But I think this is a good overview and a good start to a lot of the questions that, we see day in and day out.
Absolutely. And thanks for your time as well, Zach, today. Like I said, everyone, we're going to plan on doing a video on each one of these topics that'll cover them in a little bit more detail. But hopefully for people who are thinking about setting up plans, this is going to be kind of a nice overview for them of some things that they can consider. So they'll get some of those questions out of the way. Obviously, if you have any questions or concerns and you want to discuss the plan, reach out to us. There will be a link in the comments section below on this. Schedule a free call with Zach or myself, and we'd be glad to answer any remaining questions you've got and see if a plan is going to be a good fit for you. So thanks a lot for everybody's time.
Thank you, guys.